I'm in disbelief. I'm your host, Steve Van Metre, and thanks for joining me today. And our lead story today, we have a credit card bombshell, as you won't believe what the credit card companies are about to do and why it will have a devastating effect on the economy. Plus, we have a sponsor for today's show who's making cell-based foods part of everyday life. And we're going to show you how we think you can trade their stock for a 40% gain. Stay tuned to the end of the show or check out the description or the pinned comment for more information. Now let's head over to CNBC, where we picked today's story up with a headline: average credit card interest rate is a record, a whopping 20.69%, but experts say there's still 0% offers are out there while supplies last. Now, why does this matter so much? Because when we talk about a no landing or soft landing in the economy, or at least from the Fed's perspective, what do we need to see is an increase in consumer spending, especially on the discretionary side. So one of the challenges that you see with higher interest rates, particularly as a pass-through to credit cards, is that pushes the minimum payment up and forces borrowers to redirect from the discretionary spend into interest payments. And we know that this is also coming at a bad time, because in a matter of months, the student loan repayments will begin, and that's going to suck out even more money that would go to the discretionary side of this economy and put it toward debt service. But this problem, as you're about to see, is only going to get worse. The central bank raised interest rates 10 times this last year, the fastest pace of tightening since the early 1980s. That has caused credit card rates to hit an all-time high. And even though the Fed has hit the pause button on its rate hiking campaign, the cumulative effect is significant, meaning cardholders aren't going to get any reprieve because the Fed has gone into a pause. Rates have moved up. They're going to stay at this level. And what's going to happen is, of course, the minimum payment has moved up as well. And there's going to be no relief for borrowers, arguably at a time they actually need to see some. Since most credit cards have a variable rate, there's a direct connection to the Fed's benchmark. As the federal funds rate rose, the prime rate did as well, and credit card rates followed suit. Now, what's important to understand here is they follow suit with about a 2-month lag, so there's still room over the next month to see rates go even higher. And of course, if the Fed gets their way, as we're about to talk about here in a moment, well, it's going to get even much worse. The average credit card now charges a record 20.69%, nearly 5 percentage points higher than the beginning of last year. And while the skip means interest rates might not rise again this month, the high credit card interest rates consumers are currently seeing are going nowhere anytime soon. And of course, this is, as we said, the timing here is terrible, because as we see an increase in those weekly unemployment claims, it tells us the economy is slowing down at a time when debt service is at record highs. And paying down high-cost variable rate debt is an urgent priority for households, but yet we're not actually seeing that. If we look into the data, what have we been talking about? An increase in consumers tapping their credit cards. They're actually pushing for higher limits. They're drawing down more of their available credit. Now, there is a point where this is going to stop. There is a level where the machine hits the red line and consumers get tapped out. They can't borrow anymore. And then all of a sudden, what you're going to see is a shift, and they're going to start paying down those credit cards. Again, pulling more money away from the discretionary side of the economy that is in dire need of more spend. Experts often recommend moving that balance from a high interest rate card to one with a no interest rate or low interest rate balance transfer to offer reduced amount of the interest you're paying if you can get it. Because here's the challenge right now. If you look at consumer loans, here we're seeing credit cards and other revolving plans at all commercial banks. If you can believe this, we're sitting just shy of $1 trillion of revolving debt that's highly sensitive to anything the Fed does. So when we talk about how the Fed really doesn't have a lot of power in terms of using the federal funds rate and with this effectiveness of moving monetary policy around, well, one place it does and is highly effective is affecting these revolving credit card balances, revolving loan balances. And you see these balances may not change, but the interest rate does. As the rate goes up, of course, that means consumers and borrowers have to pay more, and that is a problem we don't want to see right now. And it's about to get worse, as Fed's Powell says higher interest rates needed to curb the economy. Says timing the moves will be decided meeting by meeting, which is not a shock because that's what they say every time. The problem is their forward guidance is now predicting rates are going up a whole lot more. And Federal Reserve Chair Jerome Powell said policymakers expect interest rates will need to move higher to reduce U.S. growth to below its long-term trend and contain price pressures, with the timing of additional increases based on incoming data. And he's beginning his meetings in front of Congress today. And of course, we know he's already going to tell them, look, inflation is my #1 priority. We've got to bring it down. And as far as we're concerned, the only policy tool we really have, or we actually have two, of course, we know quantitative tightening is a policy tool, but they're really running the limits of what they can do there. Their main policy tool is a federal funds rate. We know we're going to hear from Powell over and over again. We heard this morning the funds rate has to go higher until inflation comes down. And the Federal Open Market Committee paused its series of interest rates hike last week for the first time in 15 months, leaving rates in a range of 5 to 5.25%. But here's the problem. This is what the credit card companies are seeing. This is what they're going to react to in the months to come, as Fed officials estimated rates would rise to 5.6% by the end of the year, according to their median projection, implying 2 additional quarter% rate hikes, following, of course, surprising persistent inflation and labor market. Well, they say strength, but we know the labor market is weakening. So what this means for credit card holders is by the end of the year, assuming the Fed actually meets its predictions, there's going to be 2 more hikes. That means interest rates on those cards are going higher. That means minimum payments are going higher. And again, you look at the timing of this with the student loan repayments coming back, it's absolutely terrible. You can actually now start to make the case where the U.S. economy is going to start to grind to the halt in somewhere between the 3rd and 4th quarter, as it just comes to grips with all of these debt services coming to roost and people having to pay their bills. Nearly all FOMC participants expect that it'll be appropriate to raise interest rates somewhat further by the end of the year, as reducing inflation is likely to require a period of below-trend growth and some softening of labor market conditions. And here we finally get maybe Powell admitting the truth that we're actually already seeing the labor market slow down. We've noted over the last 2 weeks that weekly unemployment claims are over that 250,000 benchmark. They're 261K. We'll get some new numbers tomorrow that we'll take a look at. But what he's saying is below trend growth. That is what he's calling a mild recession. But one of the things is he's got wrong is we are going to see perhaps more than just labor market weakness to bring inflation down. Here we can see this chart of the consumer price index against the 4-week moving average initial claims. And here we can note that any big, large move down in the consumer price index, where you see the blue line going down, I want you to know that it is usually associated with a large rise in weekly unemployment claims. This, again, the 4-week moving average. So this suggests that in order to bring inflation down, as Powell wants, that soft landing's not going to happen. It's going to hit the labor market at the worst possible time, again, as they face those credit card payments going higher and those student loan repayments coming back. And here you can see the fallout will start. This is where you want to be watching, as restaurants are now facing unappetizing slowdown. This consumers buckle amid 2-year inflation storm. Now remember, we saw a lot of hiring in the leisure and hospitality space. A lot of that was in the restaurants as well. They're staffing up for the summer, thinking there's going to be demand. But many of you know that you ought to eat these days is not cheap at all. In fact, it's quite expensive. In fact, weigh in the comments, what do you think about eating out? Are the bills just getting outrageous? Do you think it's still reasonable? I want to hear from you, but let's look at the story a little further. According to Bloomberg Intelligence's Michael Halen, he penned a new note titled "Second Half Restaurant Sales Inflation Killing Appetites." What he's noted is consumer spending finally buckles under more than 2 years of inflation and price hikes. And what he sees is people trading down, which could start as early as this summer, meaning there's going to be headline restaurants that are going to face the fact that there's going to be less demand, as consumers just can't afford to eat out there. He says casual dining industry same-store sales rose a mere 0.9% in May, as traffic dropped a whopping 5.4%, as they expect cash-strapped low and middle-income diners to cut restaurant visits and checks through the end of the year. So dropping 5.4% of traffic is substantial. That's going to get worse. Again, as you see, these credit card balances are stuck at these high interest rates. It's going to force the Fed at some point to cut. You can actually see this playing out. The Fed is almost going to be forced to go back to zero and possibly even find a way to take the funds rate negative. But are there other indicators the economy is slowing down? Well, we got one from a big place, FedEx. FedEx quarterly sales fall a whopping 10% as the big shipper struggles to continue on. And on Tuesday, FedEx posted its third straight drop in quarterly revenue as the delivery giant adapts to weaker demand after pandemic-fueled boom in business. So this is notable because if you actually go into that article, they actually don't really touch on much of the demand side. Other than there's actually two sentences. This is the third straight drop in quarterly revenue, and that is substantial because FedEx actually is a big indicator of where the stock market is headed. And under that note, you see weaker demand after pandemic fueled boom. No surprise, without fiscal and monetary stimulus and high inflation, consumers just have less to spend. They also note the sales fell a whopping 10% in the quarter, falling short of what analysts expect. In this case, we don't care what analysts expect in this story. What matters is people are spending less money. If FedEx is seeing their revenue drop, their sales fell 10%, it tells you consumer spending is less. We see it now in the restaurant space. It's all coming together as we're seeing what is going to likely be a third or fourth quarter hard landing of the economy. And why does FedEx matter so much? Well, let's take a look at this chart here. Here we have FedEx. This is in the chart in the green and red and charted against the S&P 500 in purple. And what we can note is that when FedEx stock is underperforming relative to the market, well, it means the broad market is coming down. And oftentimes when FedEx is outperforming, it means the market is headed higher with it. And there's cases like now where the market is rallying and everyone believes we're breaking out into a new bull market, and FedEx's stock is saying, hold on a second, wait a minute, we're seeing demand come down, and that's actually not a good sign. That tells us where the market is going. What it tells us is the stocks are actually more likely, at least the broad market, to come down and catch down to FedEx because the economy is slowing down in a marked way. But one thing is not slowing down. It's our sponsor for today's show. That is Colt Food Science, who is making cell-based foods part of everyday life. They are the food technology pioneers, obsessed with developing and commercializing the world's first cellular agricultural products and brands. You can find them on the CSE trading under the symbol CULT, on the OTC under the symbol CULTF. Let's take a little bit a look at this company and what they're doing, and then we'll show you how we think you can trade their stock for a 40% gain. Colt is shorthand for cultured or cultivated, and we are the first mover using cultured and cultivated ingredients to revolutionize the food industry. We use cell cultures to produce meat, dairy, and enhanced food ingredients without tearing down a forest or taking a life. This is the future of food, and it's happening now. And for those of you who are wondering, is this plant-based? The answer is no. Their approach creates real, genuine, molecularly identical animal ingredients without the need of an animal. And they're building a house of brands. If we look at their vision, the long-term potential and capital light and profitability, they're looking to build a diverse portfolio of brands, each with distinct target markets and value propositions, and then leverage those synergies and shared resources to maximize efficiency and reduce costs. And here's a look at some of their portfolios and partners. Their global portfolio spans 4 continents, and they have a focus on new cheese, and new cheese exemplifies Colt Food Science's commitment to delivering innovative, sustainable, and profitable pet food solutions to the market. They're looking to launch this in 2023. It's going to be their first product set for commercialization, offering cultured pet food solution. And here's their plans for new cheese and their entry into the pet food space. Their pet food division is poised for continuous growth and product expansion, demonstrating their unwavering dedication to innovation and securing a strong position in the market. They're looking to launch new cheese here in Q3 of 2023. They're going to have a range of products that's coming out in August. And why start with pets? Well, targeting the pet food market offers significant growth potential, lower regulatory barriers, and a strong foundation for Colt Food Science to expand into broader food sectors. Let's take a look at their charts here. Again, on the OTC, CULTF, on the CSE, CULT. Let's take a look here. We're looking at the OTC, and you'll notice it's trading in a range here between 7 to 9 cents. On the top side is where you see sellers. This is a supply zone. This is where dominant selling occurs. Now the buyers are down here between 2 and 4 cents. Now at the time I took the screen captures, it was trading at 5 cents. It's now down to 4 right before I hit record. We can see momentum is slowing. Look at this on the RSI. It gives us a nice picture of where the stock is going. going. We see momentum is slowing down near oversold territory. The last time it got down here, you can go back here and look what happened. It got down to oversold territory. It was trading as low as 1 cent, and then it rallied up to a whopping 8 cents, and that was a huge return for those of who are trading in between these ranges. And that's what we're suggesting. You see this 200-day moving average, this tan line here, could offer a great level of support, or that top line around 4 cents a share. This is where we've seen buyers in the past. There's your 40% return potentially. Take that 4 cents up to 7 or even up to 8 for a bigger move. That's what our targets are for, of course, coal. And here we can see, as we zoom in a little bit, you can see sellers dominate in between the 7 and 9 cent range, suggesting that as this pulls back down here, this is where you would want to look to buy. You trade between these ranges. Again, between 2 and 4 cents is where you want to buy. You want to sell between 7 and 9. That's your target for this stock and how to trade it. And here again, as we zoom in to the 90-day, you see sellers are clearly here. They're running out of space. They're getting exhausted. They're pushing the price down, looking and creating an entry point. But keep in mind, as with all of our sponsors, you're under no obligation to trade the stock. Do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.